So these are the type of insurable interests that we're looking for, not at the top part here, but the bottom part. So we're looking for those actuarially determine those additional insurable risks that a business may have. So these are insurable risks that a business can insure for that would not be their normal, like above their catastrophic. So these are additional insurable interests that are just as insurable, just as deductible as their primary, the catastrophic up above, but these are the kinds of things we're looking for. So let me put some numbers to this. So let's say we have a business with a gross revenue of $10 million. And typically, a business is going to have about 10% of their gross is going to be their additional insurable interest. So following that through, that would mean a $10 million business would typically have about $1 million of additional insurable interest. And that is actuarially determined by a third party. And that's really important. So a lot of things that we do, we try to make sure that if the IRS wants to attack us, that we would shore up all those things that they would want to attack us for. So that's one of the reasons why our additional insurable interests are determined by a third party actuary. That's all they do. They'll determine how many of these things and even other things that are not even on this list that particular business may have that would be additional insurable premiums. Okay, so so now actuarially we determined that business typically would have about $1 million of insurable interest. So they could pen a check for $1 million of insurance premiums, and that would come off of their top line, meaning you had a $10 million business, and now that $10 million business now has it's $9 million of gross revenue that would be taxable before any expenses. So let's just keep that out of there. So you took $1 million straight off of their top line. And let's say that private insurance, as I told you, that there's the operating company, the private insurance, the check came from the main operating company and was given to the private insurance company, and that private insurance company now has $1 million in it. So let's say that private insurance company, with between seating fees and other expenses, would have about, let's say it has about $100,000 in expenses. That would mean that private insurance company has $900,000 of profit in that private insurance company. And that could be distributed out as a dividend. Now, I told you before, the 100% owner of that private insurance is the Roth. So where do you think we're going to drop that $900,000 of premiums, not premiums, but dividends? We're going to drop that into the Roth 401k. So now that money's sitting in the Roth 401k. So a lot of people will ask, well, that's way above the contribution limits. This is not a contribution. This is a dividend, just very much like, if Tesla issued a really good dividend and you own Tesla stock in your Roth 401k. Very similar situation. This is a dividend. So you just dropped $900,000 into your Roth 401k.
Hey,
And
Stefan, could
yep,
you go to that the slide where it shows the diagram of how that looks?
yep, this one here.
One more. You got to go down the one after the trust. We're not a trust.
Gotcha.
That one. That's the one that shows it.
Yep. Yeah, I probably should keep this up while I'm explaining that. So this is how it flows. So from the main operating company down to the private insurance company. Private insurance company has whatever expenses it has. What's left over is the profit. And that profit, because the Roth 401k owns 100% of that private insurance company, that dividend goes into the Roth 401k. Now understand the Roth 401k is a Roth, so it has all the same rules as any other Roth. So at 59 and a half, that money distribution becomes tax-free. So in this scenario, the primary business got $1 million deduction for premiums that were paid to the private insurance company. And that private insurance company had a net profit of $900,000. And because the owner of that private insurance company is the Roth 401k, that $900,000 is now sitting in that Roth.
And that's beautiful right there. So how long has private insurance companies been around?
So private insurance companies been around in some fashion since the 1600s. So most people think of it as captive insurance, and there's other names. And I'll admit that it has gotten a bad connotation, and that's mostly because it it what you're hearing about is the captive insurance is code section 831B. We do not use 831B. We are a true private reinsurance company. So we're using code section 831A. So we still follow a lot of the same rules because we want to make sure our clients are protected from audit, but we don't have the restrictions as far as capitalization. We don't have the ownership structure requirements because in an 831B, the ownership structure of the private insurance company has to mimic the ownership structure of the main operating company. In an 831A, we don't have that requirement. So this can also act as a wealth transfer plan, meaning you can have other people own shares of this private insurance company that are not related to the business at all. Meaning, if you want your children to have ownership, you want a relative to have ownership, anyone can own that private insurance company through their Roth 401k. It does not have to mimic the original ownership structure of the original business like an 831B does. So
Yeah,
it can
because I know. Oh, go on.
good. So it can be a wealth transfer plan as well.
Yes, and that's one of the things I like the most about this plan is because I got introduced to captives about 10 years ago, and then I got books on captive insurances. And one of my mentors in the alternative space, he had a captive set up, and he was just dumping a lot of money into it. And that's what got my attention
Yeah.
because it reduced his business risk. He created in private insurance to reduce his captive, reduce his business risk. But then, as I learned from you all, that it was more restrictive than what this plan is.
It's more restrictive, and also it think of the difference between the two, the 831A and the 831B. Think of an 831B as like an IRA plan. You can defer that tax, but somewhere down the road you've got to pay that tax. And then the 831A, with the ER3 plan, it is in a Roth 401k. So at age 59 and a half, never to be taxed again. So you can see the difference between the two here. This right here, this column right here is the 831B after tax, meaning you got to pay that tax somewhere down the road versus no tax ever at age 59 and a half. And you can see there's about a $1.5 million difference between the two, and that's the difference between tax deferral and tax free. Here you can see it on a chart. You can see the $1.5 million difference. And the difference between the two, putting everything else being the same, investing the same amount of money, everything else is exactly the same. The difference between these two is the difference between tax deferral and tax free. At tax free, it's going to end up being about $1.5 million more in that account in 20 years than it would be if you were using an 831B and deferring that tax.
And then here's something else I've learned as I gotten used to being introduced to this specific circle is have any of you ever gotten extended warranties? So, Stefan, what is an extended warranty? What do they use?
So an extended warranty, and the reason why this is the extended warranties, a lot of different industries use it, but the most prominent is the car sales industry. Car sales industry, you notice when you buy a car, they're always pushing that car warranty, and they know it's very predictable. So they know that only about 30% of the time is someone going to file a claim for that car. So they know predictably at 70% of the time that there's not going to be a claim. So it's very easy to predict. And so they're willing to put money behind that, knowing it's very predictable.
Mhm.
And I would imagine that a lot of different other industries, electronics and others, I would imagine the numbers are somewhat similar or maybe even better. Maybe
Yeah,
on a
because
smaller item, you're probably not likely to file against rather than, a car for a bigger dollar. So maybe it's more like, 20% or 15% of the time someone would file a claim. But
Yeah,
that's why
because when
it's so popular because it's very predictable, from an actuarial standpoint, how often someone's likely to file a claim.
and it's a profit center, isn't it?
Big time profit center. They know predictably how often somebody's going to file a claim. I'd be curious to see some numbers on electronics industry and some of the other industries, how often someone actually files a claim. I would
Yeah,
think
because
most
we had
people have totally forgotten that they ever bought that warranty.
that's right. And that's one of the cool things about this strategy right here, everybody, is, because like electronic stores, you go buy couches, you go to Best Buy. It's a lot of industries that are pushing extended insurance company, knowing that from an actuarial standpoint, very few people are going to use a profit, and and it's issued as a dividend.
Right.
you
So
know,
that industry loves that because they know it's very predictable profit. So
yep.
they're pushing it
So
hard.
and they push it hard because I used to work for a company. And they say, how many extended warranties have you done before? Now,
Right.
when you look at this strategy, Stefan, why? Because I had some people say, well, isn't that IRS going to get angry? When they find out about this, are they going to shut it down? Because I had people say that. And let
Well,
everybody know.
understand this is established law. This is just it's just bringing two genius ideas together. So what you're doing is taking your private insurance or captive insurance and taking all the risk factors out of it. I mean, not all of it. I mean, can I say they're never going to get audited? No, I can't say that. But what we've done is try to take all the things the IRS doesn't like. For example, IRS does not like trusts. They don't like you using trust to set ups. We do not use a trust. This is set up on a Indian reservation in Oklahoma using sovereign nations rules. And the insurance commissioners on the reservation as well. So it's a sovereign nation. It's like its own country and it has its own set of rules. They don't like they don't like offshoring the money. So this is not offshoring the money. It's in Oklahoma on an Indian reservation. It's not offshored. So what we've done is taken all the things the IRS does not like about an 831B plan and gotten rid of those things. So our clients are even more protected and we don't have the cap restrictions. And the biggest thing is we don't have the disclosure requirements. We don't have to disclose to the IRS that we're doing this. So we're a private reinsurance company versus an 831B where you have to declare that. So you're increasing your chances of being audited by being an 831B, meaning a true captive insurance. This is not a true captive insurance. This is private reinsurance.
Yep. I know in the chat someone asked, are we doing this for a group of companies or this is individual companies? And also, if a company has a partnership, how does this work? And then I have to get off the Zoom in about 5 minutes because I'm leading another group. But
Gotcha.
explain that.
I mean, there is interaction because I've asked Craig and company about that before. Because I have a client that has 7 companies, and he said that's great because now there's interaction between the companies and the insurable interest. There's now interaction between the companies, so the insurable interest for 7 companies would actually be higher than just one company alone. So can you group companies together if they have somewhat similar ownership structure? Keep in mind that Roth 401k and the Roth 401k owning that private insurance company doesn't have to have anything to do with that operating company. So can we group more than one business together? That's probably a question more for David, but I don't see that being a problem because
That's
it really
cool.
doesn't have to have anything because an 831A doesn't have to have anything to do with the ownership structure of the main operating company.
Now, what if a business owner already has a 401k? And because I know we have participation requirements, we got discrimination requirements when
Right.
it comes to 401ks. How would you structure that?
So Roth 401k is what we're after. So we don't want to use a 401k. We want to use a Roth 401k. So because the 401k would be like the 831B plan, a deferral, versus we want the Roth 401k. So can they use an existing Roth 401k? Absolutely. We just need to have that Roth 401k buying shares in that private insurance company. So how it got there is not that important. So our system is structured for a business owner that doesn't have a Roth 401k. And a lot of businesses, they have, employees, but their employees may not participate in a Roth 401k. Like I've got the client that I told you about before. He's got employees. They somewhat participate in the 401k, but nobody participates in the Roth 401k. So he can't either. So what we do with him is we set up a solo Roth 401k. What we do is we have a certain amount of income for him as a sole proprietorship, $135,000 worth. And with that, we can fund enough to have $50,000 in his Roth 401k. With that $50,000, he's going to buy the shares, the premium shares in that private insurance company.
So what if there's someone gets a chance for auditing? Because I know in the chat it said that let me go back here and let me read it. He says, I asked for auditing purposes. I've heard of chances of an audit goes up if it's just one company self-insuring instead of paying to a plan with other companies. So what happens if an audit does come up?
Well, like I said, we've done all the due diligence on the work to make ourselves as audit proof as we can. So we've figured out what IRS doesn't like about captive insurance, and we made sure that we're not anything like that. So we've gotten rid of the things that the IRS doesn't like, and to be fair, IRS is back down considerably on their dislike of captive insurances. They thought it was highly abused, and they've since backed down and said it's not as abused as we thought it was. But yes, there are some bad players out there. You've got people that are borrowing the money out and doing things that was never designed to do. Not to say you can't ever borrow it out or you can't invest in your own company. There's ways to do those things, but people were doing it wrong. I mean, it's like getting your big fat deduction and having your cake too. Yeah, yeah, that's not good.
Yep. Hey, could you go to the slide where it shows the industries that are
Yep.
could be target market? And here's something right here. I was talking to a banker yesterday, and we're networking. And the cool part about this strategy is what's a good fit? We look at a company that has gross revenues of 500,000. That's a guideline,
Yeah, that's a
500,000.
guideline. And keep in mind, this is not an all-inclusive list. So this doesn't mean this is it's not like R&D where you have certain requirements and most people don't fit into those requirements. So this is not an all-inclusive list. This is just a list of typical businesses that would probably qualify. But the real qualifying determination is, do they have enough funds to be able to fund a Roth 401k? And that's where the $500,000, gross revenue came from. With a business with 500,000 gross, they probably could afford to fund a Roth 401k to make this thing work.
Because they have to buy the initial amount of money that has to be purchased, put into this plan is 50,000.
Correct. And that's where that number come from is a business with a $500,000 gross probably could afford to drop $50,000 into a Roth 401k.
And what does that $50,000 do? What does it purchase?
So that $50,000 is used to purchase the premier shares in that private insurance company.
And that's the preferred stock, and that's the sweet spot, everybody,
Yep. There you go. And that's
is
why
because
that
that
dividend comes
preferred
directly
stock.
over. Yeah, that's why that dividend comes directly over. That's very, very important, very critical, because those shares are owned by the Roth 401k. So when that dividend is being distributed, it's distributed to the Roth 401k.